Hey, Smarty Pants! I'm going to be giving you a bunch of student loan repayment strategies to reduce the total cost in interest, potentially saving you thousands of dollars on your student loan interest in just a few years. And then I'm going to show you why you probably shouldn't use them.
Or more accurately, why you should run your numbers and weigh your other options first.
So keep watching to the end where I discuss the downside of using your finite financial resources for extra student loan payments. Hey, I'm Kate. I'm the Money Librarian. If you wish that you had a smart, funny, maybe a little bit snarky friend to help you understand money more so that you could save more, have more, stress less, then hi, welcome to my channel. If you're looking to reduce your monthly payment, I recommend you watch actually one of my other videos about the different payment options. However, if you're thinking more long-term and you want to save on the interest you're spending on student loans, this is the video for you. You probably want to pay as little in interest as possible. I'm going to show you 3 of the simplest ways to do this. I spent hours mathing out how much you could save by paying down the principal in creative ways, assuming you didn't get any major windfalls, like no great aunt dies and leaves you beaucoup dinero. No, this is for normal people who have a little bit of extra cash every month and they want to know what will happen with their student loans if they use it to pay off their student loans faster.
This is educational and informational. Personal finance is just that. It is personal, so consult a financial professional to find out what's best for you.
For all of my examples, I'm going to be using a $50,000 in direct loans, paying on the 10-year standard plan with a 6.5% interest rate. If we paid $50,000 on the standard 10-year plan, your payment is $567.74 a month. Over the 10 years, you end up paying $68,128.79, so you pay $18,128.79 in interest over those 10 years. The first payment in this scenario that I've created is January 1st, 2024. The last is December 1st, 2033. Here are the scenarios where you can pay down your student loans, get them out of your life a year faster, pay thousands less in interest, and it doesn't really feel all that different from what you're paying right now. The first scenario,
pay half every 2 weeks.
With this, you end up sending in an extra payment every year, but it doesn't feel that way. This is really good for those people who get paid bi-weekly. So that way you just know a certain portion of every single paycheck will go towards your student loans. In my scenario, our payment is $567.74. Cut that in half for $283.87 every 2 weeks. That means you'll send in 26 payments throughout the year instead of 12. So you end up paying a full payment extra, but it doesn't feel that way. Doing this, you would save $2,218.69 in interest and take a year of payments off your loans. I also want to say, if you do want to pay your student loans down much faster, you have to tell your servicer what you want them to do with that extra payment, because by default, they will usually just apply it to your next payment. So it won't actually pay down your loans any faster. It'll just take care of next month's payment. You have to usually log on to your student loan servicer and say, hey, any extra payments I want applied to the principal. Second scenario, pay a lump sum in January with flush Christmas or holiday cash. Let's say you don't want to go through the rigmarole of remembering to pay every time you get a paycheck every 2 weeks, and instead you pool holiday checks from grandma, grandpa, aunties, uncles, everybody, and then just double your January payment. When paying off debt, lump sums, especially lump sums early on in the debt repayment, are fabulous because you knock down that early principal so much that you save interest through the entire life of the rest of the loan. Because you're basically just sending in one extra payment a year, it kind of washes out in the same way. You save $2,250.77 and are paid off a year earlier. So you save $30 more than in the first scenario, and you get paid off at around the same time. Now, you may be saying Kate, you said I'd save a lot more with a lump sum. Yeah, and for many debt payments, it will. But the thing is, 6.5% interest isn't bad. What a lot of people don't realize is the math behind student loan interest actually is way better than a lot of other debts for the borrower. First off, credit cards charge bonkers interest, like 29.99%. And they figure out your daily interest and add it onto your principal every single day. Student loans determine your daily interest on whatever the balance is at the beginning of the month. They take that daily interest, multiply it by the number of days in the month, and that's the interest accrued for the month. This is where lenders get very smart people. It doesn't sound like a big deal for the interest to accrue once a month or every day. But when you math it out, it really does make a huge difference.
Thank you for coming to my TED Talk.
Scenario the third. Increase your payments by $50 a month. In this last scenario, you send in an extra $50 a month. That's not breaking the bank for most people. What would that do? Compared to the standard 10-year plan, you end up saving $2,145.55 from the 10-year plan. You pay it off a year early, just like in the other scenarios. And you know what I say to all of this? Whoop-de-doo. Why am I salty about this? Do kids still say salty? I don't know. I've been out of the game for a while. Anyways, I'm salty because overpaying on your student loans for most people means that you're neglecting your other financial obligations. And those other financial obligations, over the long run, may net you far, 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 far more than the $2,000 or so that you save from overpaying on your student loans. So here's the facts. In all the scenarios that I offered you, you save about $2,000 and take a year off your loans. Cool. What about your savings? What about your retirement? What if you have a medical emergency? What if your car breaks down? My worry is that too many people get obsessed with their student loans and getting out of student loan debt to the detriment of all the other things that you really need money for. So let's pretend that instead of doubling a payment or sending in half twice a month, you put that money into your retirement fund. That is an extra $567 a year going into retirement. Now, assuming an 8% return, I mentioned that this is for educational and informational purposes only. This is not investment advice, just straight up rules of thumb and math. What do you think your balance would be in your retirement account at the end of 2032, that same period when your student loans are paid off? How much money is in that retirement account? $7,656.86. So would you rather save $2,200 in interest over 9 years or have about $7,500 in 9 years? Let's pretend you never put another penny in that retirement account. You just leave it. After 20 years, you have $17,853.04. Or you could save about $2,200 on your student loans. A lot of people think that the stock market always goes up. No. The stock market cannot guarantee a return. I'm using a conservative 8% average. So just know that money in the market could be lost. What if you don't want to take those ups and downs? What if you want to secure your money? Okay, let's just put that money into a high yield savings account getting 4.5%. And I know 4.5% interest is not normal, but that's what you're getting right now. That's the number I'm going to be using. At the end of 2032, you'd have $6,439.35. Or you could save about $2,200 on your student loans. Oh, and it gets even crazier when we look at that $50 a month option. This is just a few dollars more than the last scenario, but it's a few dollars more every month. Year over year over year over year. And that money adds up. If you invested it at the end of 2032, you'd have not $7,500, which was what I mentioned in the other scenario. Now you have $8,091.92. In 20 years, you have over $20,000 in that account, $50 a month for 9 years. Or you could save about $2,200 on your student loans. And if you had saved it, if you just put it in a high yield savings account, at the end of 2032, $50 a month turns into $7,200. Or you could save $2,200 on your student loans. And before some bro comes at me for incorrect math, the reason you have so much after 9 years is because you don't have that last year of payments. Essentially, the $6,800 you'd pay on the last year on the 10-year plan is wrapped up in these numbers.
As rose-tinted as these numbers may seem, don't forget you still have an entire year of student loan payments at the end of these. This may not be right for you. Do what is best for you.
As a financial coach, as somebody who is an expert in personal finance, though, is that life is going to be happening to you for those 10 years while you're repaying your student loans. You're going to want to buy a car. Maybe you're going to go to travel. Or maybe you're going to want to have a big wedding. You got to do all these other things. You have other financial obligations that, pay attention to. Student loans aren't your entire financial life. They're one part of your financial life. Maybe they're a big part, but they're only one part of your financial life. I'm not trying to tell you what's best for you because only you knows what's best for you. If you can't sleep at night because of these student loans, then yeah, pay them down. But there are plenty of scenarios where paying down student loans makes sense. What I'm saying is that I want you to run the numbers before you start overpaying on your student loans. Just Google, student loan overpayment calculator, student loan calculator, something like that, and pop in, okay, well, what if I pay an extra $50 a month? What if I pay an extra $100 a month? See how much money you really will be saving.
And then weigh that against your other financial obligations.
And if you don't have an emergency savings account, if you don't have money for when there is a medical emergency, when your car breaks down, when something terrible happens, you're going to end up charging it to your credit card, and they are going to charge you 29.99% or whatever bonkers interest rate credit cards charge, which is an absolute eye-wateringly large amount more than your student loans are costing you in interest. Once you run the numbers, it will give you so much clarity on what your next step should be. You know yourself really well, and if you know that you're not going to be putting towards retirement, you're not going to be putting it into a savings, all you're going to be doing is spending that extra money on Pokemon and bubblegum, then okay, yeah, sure, pay down your student loans, have fun. But if you are the kind of person who will increase your at-work retirement account or your IRA, then please consider your long-term financial goals and know that emergencies will happen. It's not if, it's simply when is an emergency going to happen. Personal finance is personal. Do what's best for you. Speak with a financial professional before making any moves. But as a general rule of thumb, goals like maxing out your retirement, having a fully funded emergency fund, saving for goals like home, car, travel, a wedding, and never getting into credit card debt should probably take precedence over saving a few grand on your student loans. I know how much stress student loans cause millions of people, and I hope this makes you feel a little bit better. Does this kind of blow your mind? Or going to go run the numbers? Let me know in the comments, you guys. And if you know someone who's desperate to pay down their student loans, do them a solid and send them this video. Cheers. Okay. Okay. Okay, I'll probably use this for a blooper. So anyways, the googly overlords think you should watch this video. Give that a click.